Hi guys, I'm AP. In this video, we are going to see the chapter 7 in the book The Intelligent Investor. The chapter 7 is the enterprising investor's positive side. As for now, we seen about the difference between investor and speculator and the history of stock market and the inflation one should consider in the investment journey and the portfolio policy of the defensive investor and how to select a common stock for a defensive investor portfolio. And in the previous chapter, we seen about the negative side and the enterprising investor. Now we are going to see the positive side in the enterprising approach or an aggressive approach towards the market. Okay, let's get started. At the beginning itself, Graham mentioned the difference between the defensive investor and the enterprising investor or an aggressive investor. A defensive investor is who have a high grade bonds and a common stock in his portfolio, and he will never worry about the market fluctuations. He will continuously invest some amount in the market over a period of time to get a return from it. Okay. On the other hand, the aggressive investor is who continuously analyzing the market and finding then a new opportunity and where he can invest his money to get a higher return from it. The one who spends more time and energy in the market is who an aggressive investor or an enterprising investor. Graham clearly states the difference between defensive and aggressive investor in the starting of this chapter itself. Okay. Even though in this chapter, Graham gives some advice to be an aggressive investor, but he will never consider one should have a 100% aggressive investor portfolio. He should always consider buying a high grade bonds and a common stocks at least around 60% in his portfolio so that he could risk his 40% of remaining money to be an aggressive investor. Now let us see the positive sides of the aggressive investor. Okay, in the securities market, there are two types of instrument we can invest. One is the bond market, another one is the stock market. Okay, the aggressive way of investing in the bond market is buying a high yield bonds. There are two types of high yield bonds. One, the company itself is a not well established company or a small cap company. They are issuing a bond to raise a capital, and there is no enough financial statement for the company, or the company is making little bit of loss. Management of the company is not so big and prominent. If the company issues bond, Graham called that as a junk bonds. We can invest in it and get a higher returns than compared to the market average returns. Okay, but there is another special situations in that even when the good company is going towards a bankruptcy or they are in a trouble at the bankruptcy situations, they will issue bonds to increase their capital. If the aggressive investor has an study and confident in that company so that he can buy the bonds at that bankruptcy situations, the bond issued by the company, the yield will be so high because their credit worth is so low because they are filing towards the bankruptcy. Okay, now the investor has a two choice. The first one is already existing bonds for the company in the market, in the secondary market, the value of the bond will be too low. Either he can buy that bond or he can buy the fresh issue bond by the company itself if he has confidence in the management of the company and the promoter of the company. If the promoter of the company is so highly skillful person, then he can turn around the loss making company into a very high profitable business in the future so that the investor can get a high returns compared to the average market returns. Okay, now let us see an example for the aggressive investment in the bond market. We all know that Graham as a defensive investor and a fundamental analyst. But in the 2008 financial crisis, the Goldman Sachs and the Bank of America is in financial trouble. At that situations, the both companies issuing a bonds with a higher interest. Even though the world is so negative about the bond market and the stock market, Buffett, with his knowledge and confidence, he is confidently buying the bond issued by the both companies, and he is making a huge returns in the future only because he has a knowledge and an aggressive type of investment in the special situation itself. Buffett, being a student of Graham, he never buys the junk bonds. He waits for the special situations like this, the financial crisis, so that even big prominent companies, they are financially troubled situations, issuing bonds by using the special situations. The Buffett made a huge profit in it. Okay, now let us see the aggressive way of investing in the stock market or buying a common stocks in an aggressive way. Okay, Graham classify this into four types. One, buying in the low market and selling in the high market. Second one, carefully choosing a high growth stocks. And third one is buying a stocks in the special situations. And fourth one is buying bargain issues in the various types. Okay, now let us see the how to buy in the low and sell in the high markets. Okay, Graham states that buying in low market is nothing but the bear market. One should confidently buy the growth stocks are common stocks in the bear market, so that in the bull market he can make profit out of it. Now we are in the September month of 2023. As of now, the market is around 20,000. At the beginning of 2023, around March, the index is corrected about 30% because of some Adani issues and the Hindenburg report on him. But everyone are bearish in this, want to buy a shares of it. I am not specifically saying the Adani shares, but also the index is corrected around 30%, but no one invested in it because we are in a fear state at the bear market. It's a mistake everyone are doing in the bear market. Graham says once we find a common stock, then even though it is a bear market, we should consistently invest so that in the bull market we can get a profit out of it. And we should also consider exiting in the bull market or when the market is so high so that we can retain some profit amount in it. Okay. Now let us see how to carefully buy a growth stocks. Graham states that the growth stocks always valued at the high price, or the share price of the growth stocks is at high because it is always ahead of earnings when we compare to the average earnings of the index. Okay, we are considering a stock as a growth stocks because it has done a average returns more than the index in the past years. But by considering the past, we cannot take decisions for our future. Future's market value or a future economical situation may be differ for the stock or the interest rate cycle may be different from the past to the future. So that we cannot consider by one stock from the past performance to held as a future. So that Graham consider that we should always buying a bunch of growth stocks in our portfolio so that even though one or two stocks we may lose, but the other one will help us to make a fortune in the future. Okay. Now let us see the how to buy a stocks in the bargain issue. Bargain issue is nothing but when the company want to raise a capital, a working capital, then without issuing new shares, the company can give a rights issue to the existing shareholders to buy a share. At the time, the shareholders can buy the shares at the bargain price or the price less than the market price, so that the investor can get a profit out of it. This is what Graham says the bargain issue. But we should be confident that the companies will do well in the future because the company will raise a rights issue only if they are in a trouble situation or when they are financially troubled, when they need a capital to pay off the debt. Okay, now let us see the special situations. The special situations is nothing but when the company is merging with other company or the company is merging itself from one company to two company, then we can get the arbitrage opportunity while buying or selling a shares from the company. Okay, the recent example is the merging of the Tata Motors DVR and the Tata Motors share. If we buy the Tata Motors DVR share at the merger, we can get the definite profit of 7% because of the arbitrage traded in the market. And the current example is the IDFC First Bank and the IDFC the merger. If we buy the 100 shares of IDFC First, then we can make a definite profit of 7% according to the market value. These are the special situations mentioned by the Graham. Okay, let me conclude this chapter by saying that while choosing a growth stocks, don't select a handful of stocks. Always select a bunch of stocks. If one stock doesn't perform in the future, other can help us. But we should be so cautious while selecting the growth stocks. Selecting the growth stocks in the past performance, but there is no guarantee that the stock can perform in the future. Even though the stock performs in the future, the share price can go down or doesn't move high to give return for us. So that we should be careful while choosing a growth stock. I always advise you to be in a defensive way of investing by selecting high grade bonds and the common stocks or the blue chip stocks in our portfolio. Okay, chapter is the very important chapter. The Buffett also mentioned in the preface of this book. The chapter 8 is nothing but the investor and the market fluctuations. Okay, stay tuned. Thank you.